Hello and welcome to Livewire Markets. I'm David Thornton. Today we're sitting down with Hall of Famer Chris Cortis, Portfolio Manager and Director at Ellerston Capital. Now Chris has been in markets for almost 40 years. He's seen crisis after crisis. So today we're going to chat about how the past 12 months measure up and how a self-proclaimed fully invested bear is finding value in today's market. Chris, thanks for joining us.
Always a pleasure to be on your show. Thank you for the opportunity, David.
So you've been in markets, like I said, for almost 40 years. How does the past year stack up?
Every year is always different. I suppose this year has been a little bit unique in the sense that, contrary to conventional wisdom and confounding all the pessimists, markets have actually performed pretty well, and the economies have been very resilient as well. And if you'd asked me 9 months ago, I would have expected a worse outcome for equity markets. We've had unprecedented rate rises by all the central banks, and in many ways the real economy has been totally out of sync with global equity markets. And you know, to put that in perspective, calendar year to date, S&P's up sort of 15-16%, Nasdaq's been up over 30, and it's really been a bit of a fool's paradise, because when you actually scratch the surface, you'll find that it's been such a narrow rally. It's been the big tech names that have driven equities globally. So in the US, it's been the, if you like, the Magnificent Seven, your Apples, you know them all, Meta, Nvidia, Tesla, Amazon. Now, calendar year to date, they've returned over 70%, yet the S&P's done about 15 or 16. But if you were to equally weight the S&P, the returns are more like 5 or 6%. And if you look at the Russell 3000, which is the smaller cap end of the market, half the stocks in that benchmark are in negative territory. And it's the same in Australia. The market's pretty flat, and it's been driven by a handful of names.
So what do you think is going to happen? Do you think the big end of town will sell off? Do you think smalls and mids will gap up, or a bit of both?
I think they'll both sell off, to be really honest.
Oh no.
And the reason I say that is, you know, we haven't felt the economic pain yet. Monetary policy will have an effect with a lag, and you know, it's no secret out there to your listeners that the RBA has aggressively tightened. Yeah, we've had a pause for the time being, but there will be more rate rises globally by central banks, and global growth has slowed, and the second half is going to be a really tough half economically, which then sort of flows into earnings expectations. And whilst I said earlier the economy had held up pretty well, as did the earnings, they're just now starting to roll off. So I think equity returns could be compromised in the second half of this calendar year, the half we're in now.
So what do you think it's going to look like? Is there going to be a cliff as those hikes filter through the economy, or is it going to be, 1,000 cuts?
I'm more cautious, so I think it could be the death by 1,000 cuts. The reason I say that is the consumer, we're now at that inflection point where the consumer is really starting to tighten the purse strings. And you've seen it in a lot of the retail stocks that have reported recently. They've hit a brick wall. You know, I could rattle on about the Harvey Norman result till the cows come home, but again, your listeners would read the newspaper. But I think the earnings cycle, we're in a downgrade cycle for consumer discretionary. We can talk about the banks later. I have a cautious view. I've had a cautious view for a while. They've held up pretty well so far, but judgment day is coming.
We'll go back to how you positioned in a minute, but looking back for a second. Your Australian shares fund has returned about 16% over 12 months, and that's without those tech stocks, that tech sector that's carried the market. Where have you generated that performance?
Yeah, look, it's all very well to look at a 1 year number. We all have a good month, a bad month, a good quarter, a bad quarter, a good year, a bad year. I've had 3 terrific years in a row. You should always look at the 3 year numbers. It sort of smooths things out. They're top of class numbers for the record, and I'm I'm pretty satisfied with those returns. Now, in the financial year just finished, we had a number of winners, and whilst we weren't in the wise techs of the world, stocks that really ripped, I mean, that stock was up over 100% last financial year. It's just not in my DNA. It just cuts against my valuation cloth to be invested in some of these higher tech names. WiseTech would be on a P of 100, EV/EBITDA of 60 times. It's just not me, and it's not what my investors expect of me. I've always been a bricks and mortar sort of guy. So where have we captured the modest alpha in financial 23, FY23, which is now just finished? When I last saw you, September of last year, I think one of the stocks that I peddled pretty aggressively was Northern Star Resources, gold company. The stock was $7.50 back then. It rallied to $14. It's now come back to closer to 12, but that was a good generator of alpha. At the start of this calendar year, we piled into James Hardie. It had been absolutely smoked. It fell back to sort of $26.50. We've piled into it. It's $40 or thereabouts. Now we're out of the name. See you next cycle. We're gone. We've locked in the alpha. Move on. You can't just buy and hold things forever. Those days are gone. I can talk about that later if you want me to. The other alpha generator was being in United Malt. It was bid for by the French. As it turned out, the souffle did rise twice. Boom, boom. So we're out of that name as well. I'm not going to wait for the 11th hour and 59th minute for the $5 cash to hit my bank account. Come and gone. Come and gone. And more importantly, I think half the battle in active funds management is avoiding the blow-ups, avoiding the disasters. And there's been so many of them last financial year and calendar year to date. Look at the real clangers in the marketplace over the last sort of rolling 12 months. Star has caused a lot of pain to a lot of active managers who piled into it with a 3 handle. If I had $1 for every sell-side analyst that tried to get me to buy Star at $3 when the property valuation alone was $3.50 supposedly, I'd be worth a lot of coin. Avoiding the Stars, avoiding the Lend Leases, avoiding the Dominoes. Everyone loved it at $150. You can't give it away at $45 now. So avoiding the blow-ups is a good way to add alpha. It's easier said than done because we all step in a landmine occasionally and get our leg blown off. That comes with the turf. I've made more errors of judgment, mistakes I care to think about, quite frankly, and got the battle scars to prove it as well.
So how are you thinking about preserving capital as we move through this downgrade cycle?
I said it even last time we caught up that, and I was wrong because the market has rallied and has been incredibly resilient. But as I said, it's been a very narrow-driven equity rally globally and domestically. I'm still reasonably well positioned and quite, well, I think I am. You'll know that in a year's time whether I am or I'm not, but I'm more defensive, and I don't have any retail in the portfolio. I'd like to think I've got a more defensive portfolio. I own no banks still. I'm overweight energy. Happy to discuss down the track. I don't know how much time we got, but I've been buying some of the more defensive consumer discretionary names. I don't own Woolies, I don't own Wesfarmers, I don't own a lot of, I don't own Coles, but the one I do own in that segment is Metcash. Yeah, so I'm trying to be more defensively positioned. That may or may not prove correct. And I've avoided the crowded longs, the expensive defensives. I'm not in ResMed, I'm not in Aristocrat, I'm not in CSL. Well, that was supposedly a safe bet 6 months ago, and again we had sell-side analysts ramming it down my throat with a 300 handle in front of it. Well, look, it hasn't worked, and we're not there. But it is an expensive defensive, and I think some of the other names I've just mentioned may suffer the same fate, because expectations are high going into results for the Aristocrats, for the ResMeds, la.
So Santos is one of your high conviction positions. Why do you like the stock in general, and why do you prefer it to its rival Woodside?
Well, you should look at Santos in a global context, not just versus its Australian peers, and it's not just Woodside. It's the Karoons and all the Beach Petroleums and all the rest of it in Australia. But I like it because a lot of the bulls have gone really stale on it and given up on it. Just when I look at what they delivered last calendar year, they still haven't reported their June quarter yet. I'll see how that plays out. But last year, Santos, under Kevin Gallagher's leadership, delivered record production of 103 million barrels of oil equivalent, record revenue, record free cash flow of $3.5 billion. They returned $1.5 billion to shareholders in the form of buybacks and dividends. And not that long ago, they announced a new policy where 40% of all free cash flow will be returned to shareholders in the form of dividends or buybacks. So looking forward, I look at the metrics. It's on sort of 4 times EV to EBITDA, and a lot of global energy companies are on same sort of metrics, but it's dramatically underperformed its peer group. Calendar 22, Santos underperformed Woodside by 60%. Not 16, 60. That's a big margin. And I think when you look at Santos, and let's be frank, it's been a dog for 20 years, right? Every dog will have its day. And I think they've built up a fantastic asset base, which the market doesn't appreciate how good it is. And what is the asset base? People now forget Santos own Oil Search. So they've got world-class assets in PNG. Their share of LNG production is about 3.6 million tonnes of LNG. They've got QLNG on Curtis Island in Queensland. They've got the long in the tooth Cooper Basin. They've got Bayu-Undan. So they've got a very diversified domestic asset base coupled with an export LNG business that I think the market underappreciates. And I just think it just screens really cheap, and everyone's just given up on it. So I'm a contrarian by nature. I'll zig when everyone else is zagging. Everyone loved it 3 years ago. It hasn't performed. Like I said, the stock's done nothing for over a decade. It's been a chronic underperformer.
Let's move to financials. When we spoke last year, you weren't overly keen on the banks. Are you still bearish banks?
Yeah, I am. That said, banks have performed broadly in line with the market last financial year, with a return of around 14% or whatever the number was. And there was a divergence. Bank of Queensland got smoked. That was the clear underperformer. NABs underperformed, the bank BOQ underperformed the market by nearly 30%. That's a big margin, big margin. NABs was of the majors the worst performer and underperformed, and then you had Westpac, ANZ and CommBank pretty much performing sort of 15% for the year, in line with the market. Now what has surprised me is just how resilient they've been, and I think I said earlier, monetary policy will have an impact but with a lag, and we're going into that period now where I think there's something like, and I think I talked about it last time, there's 230 or 40 billion dollars of loans that are moving from fixed to variable in the current half we're in, the supposed mortgage cliff. And Mr. Millennial who borrowed $1 million during the pandemic is going to walk in a CommBank and he's going to get hit with a 6 or 6.5% mortgage rate when he thought he'd had 2% locked in for a while, or for a long period anyway. I think the risk is that the chickens will come home to roost, and you'll end up having these zombie mortgages where the banks know that party can't repay the loan, so they'll just convert it to interest only or extend the life of the loan from 20 to 30 years. The old extend and pretend philosophy, pretend the problem will go away. It'll be someone else who's the CEO in 5 years' time's problem to fix the mess, as is always the case with the banks. And you look at the performance of the banks, most of them have done nothing for 10 or 15 or 20 years. ANZ share price is the same it was 15 years ago. The only one that's added value, real shareholder wealth, has been CommBank, which has delivered over the longer term. Now, the reason I'm cautious is we haven't seen the interest rate cycle play out yet, and the credit cycle. So bad and doubtful debts, which average sort of 2 basis points in FY last year, the run rate now, if you look at the March quarter where all the banks have reported, we haven't seen the June numbers yet, that the charge has lifted to about 12 basis points, and the period of banks reversing prior provisions is over. That game's over. The cycle's just starting to play out now. And I suspect what you'll see is bad BDD charges, write-offs will kick up to about probably 25 bips. And it's not going back to the bad old days during the GFC when they went to 75. That was all the corporate collapses, your ABC Learnings and Babcock and Browns and Allcos of the world that all went belly up. This will be unsecured credit to consumers. It'll be people that can't pay their mortgage because CommBank allowed them to borrow 6 times their income during the pandemic. All those headwinds are about to come to fruition and hit borrowers, and ultimately you've got to see BDD charges going up. So that will have an impact on earnings and hence dividends, which is why you're buying the banks. But as a sector, they're on about 1.5 times price to book. Dividend yield gets dragged up to sort of around 6% because a lot of the share prices have sort of done nothing, and they've maintained their dividends. But I think the sector will come under pressure. I'm not saying it's going to collapse, but I think I can do better and allocate my clients' capital better than investing in boring old banks that still make up a fair chunk of the index, and a lot of the index huggers have got to be there because it's 27% of the market. What we do. What
about the +1 at the party in Macquarie?
Oh, well, that's not a mortgage bank. That's an investment bank and an infrastructure play, and a very complicated beast, Macquarie Bank. They've done it well. They've always done it well. I've been in and out of the stock over the journey, but quality management team. It's more for the growth managers. I wouldn't call it a value stock. And it's an infrastructure and if you like, wealth manager of infrastructure rather than a traditional bank.
All right, to close it out, Chris, what's one piece of advice you would give to investors in calendar year 23?
What's left. I'm going to err on the side of conservatism and stay cautious because I really think that the macro headwinds are real, and absent any pivot by the Fed where, towards the end of this calendar year, they start talking about monetary easing, I think the market's going to go nowhere, and unfortunately, a lot of the sort of robotic, propeller-headed millennials that are out there day trading, they're all going to go off the cliff together. I guarantee you that. So I'm going to stay cautious. I'd like to think the portfolio is defensively positioned. It never is. You'll find out. You'll look back in a year's time and say, geez, I could have been more defensive. But there's always a risk of one more blow-off rally in the market if there's a hint of a Fed pivot, but that's not going to happen tomorrow. And the economic pressures and the risk of a recession in the US is probably the can's been kicked up the road. So it's not going to happen tomorrow. So markets can rally, but I'm just staying reasonably cautious and trying to focus on companies with reasonable balance sheets, defensive earnings, less cyclical. But if they are cyclical, you want it to be priced in valuations, and you want the stock to have been smoked before you dust the file off it. I'm not chasing momentum. I'm not a tech junkie. You're not going to find me overweight banks in a hurry. I am what I am.
Well, this has been a great chat, Chris. Thank you so much for joining us.
Thank you, David. Always a pleasure. Good on you. Cheers.
Well, if you enjoyed that chat, be sure to head over to livewiremarkets.com. We've got more content like that being uploaded every day. See you next time.